After a subdued 2025, the market, prior to the tensions in the Middle East, was beginning to stabilise. We were seeing selective momentum return, with some projects beginning to move. At the same time, renewed global uncertainty, particularly in global energy markets and geopolitics, sits alongside that progress. The wider UK economy remains slow. Growth in 2026 is expected to remain modest at around 1%. Prior to the activities in Iran, headline inflation had eased to around 3%, and interest rates had stabilised. Hiring has also cooled compared with recent years, as businesses remain cautious. Construction remains in contraction, with demand still fragile, although confidence has been improving as firms looked ahead to future project pipelines. Work on-site is holding up, supported by infrastructure and repair projects. For clients, this is a moment to focus on preparation. Clear design, realistic budgets, and a defined procurement strategy will position projects to move quickly as confidence improves. Recent tensions in the Middle East have pushed oil and gas prices sharply higher, following disruption for the Strait of Hormuz. For now, this looks like volatility rather than a structural shift, albeit pressures on inflation could materialize relatively quickly, which in turn will reduce the Bank of England's ability to lower interest rates. In the near term, this may increase caution in tender pricing if instability persists, especially in civils and MEP. If high prices last for several months, costs will likely rise again. If they settle, the impact should be limited. We recommend watching how long prices stay high, review exposure in key packages, and avoid reacting to short-term spikes. Investment is returning, but carefully. Clients remain firmly viability-led, with funding clarity and risk control central to decision-making. Where costs are stable and risks are clear, schemes are progressing. Where margins are tight, projects are still being paused. What we are seeing is targeted remobilization, with the spring statement reinforcing policy stability rather than stimulating new activity. Before going to market, ensure the scheme is genuinely robust. Refine scope, clarify risk allocation, and approach procurement strategically. Pricing is becoming more dispersed across projects. Simple packages are competitive, but more complex or higher-risk work is pricing higher. Tender returns are more varied, with outcomes shaped by risk and complexity rather than inflation. Insolvencies remain elevated, and parts of the supply chain remain financially stretched. Financial strength now matters as much as price. Be realistic about risk. Choose financially strong contractors and expect greater variation in tenders. Most material prices have settled and labour pressures have eased overall. However, MEP remains the most exposed to cost pressure. Strong demand from data centres and infrastructure, along with volatile materials like copper, means MEP is more likely than other trades to drive cost pressures in 2026. Secure key specialist trades early and avoid late design changes to protect your program. To conclude, there is selective momentum, but it sits alongside renewed global uncertainty. For clients, this is a window to prepare thoroughly, manage risk carefully, and move decisively where schemes are ready. We recommend getting in touch with your G&T advisor to discuss how these trends affect your projects.